what it says, that this is what it says, is that wherever there is a bookmark like this, please read. Okay, don't take any chances. I am telling you, at least read once. Okay, read once, don't take any chances. Is that what happens? There is a, how you are going to differentiate between a financial liability and equity instrument. Okay, financial liability is a contractual agreement, fine, that they will say 5% preference shares, like that. In ordinary shares, no. What is the difference between these shares? Ordinary shares will have a residual claim. Is a residual claim on profits. If profits are there, they will pay you dividends. If there are no profits, they will not pay you dividends. Okay, this is the basic condition is there. The second one, this is first part is over. Coming back to the second one, what it says, it is a compound. Compound means there are two instruments are there. Is right? Two instruments are there. Means you have characteristics of a loan as well as equity. Okay, characteristics of loan as well as equity. What they will say? They say that is 5%, 10 years. Means till 10 years you are going to, we as a company, we will pay the loan. And after 10 years, is it right? After 10 years, the other party have the option to convert it into equity shares. They will say very clearly that there should not be any doubt. Is it right? They will say the value of the whatever the value of the loan. Okay, whatever the value of the loan, they will convert into 5 equity shares. They convert into 10 equity shares. Is that they will make very clear that how much each equity, how much loan amount, equal of loan amount will be converted into equity share. They say if there is a 100 reals, okay, usually it will be, they say it is a bond. Okay, 100 reals bond converted into 5 equity shares. Means if you are having 100 real bond, you will get equivalent of 5 equity shares. Is that this much is there? Is that repayable at the lender's option in shares? Is that it is the option. Option means you can choose or you cannot. It's your wish and will. Okay, of assuming company instead of, you can take the shares instead of cash. Number of shares to be issued fixed. Is that it will be fixed at the beginning only. Okay, at the beginning only they will say 5%, 10 years convertible into equity share, convertible into 5 equity shares. They will mention in the beginning. Again, they will not change the terms and conditions. Lender will accept the rate of interest below the market rate for non-convertible instrument. Is that they will accept the rate below the market rate. Okay, mark whatever the rate of interest, that also will be clearly determined. Is that sometimes because you have the options, definitely we are going to get the benefit at the end of the year. Convertible means converting the loans, converting the bonds, especially bonds, into equity shares at the end of the maturity. It will have an option. Okay, it will have an option. These conditions will be given in the beginning of at the time of issue, and the rate of interest will be little bit varied. Okay, the rate of interest will be little bit varied. That's what it says. As a lender, liability or debt instrument as a issuer has the potential future obligation to deliver the cash. Is a liability or debt element. As the issuer has the future obligation to deliver the cash, or equity element, and investors may choose to convert the loan into shares instead. Is it? The investors means who are giving the loan, they have the choice to convert the loan into equity equity shares. Okay, what is there? The same thing. Is that initial recognition? Is that how you have to recognize? The same concept, rule will never change throughout the chapter. Opening balance plus effective rate minus interest paid is equal to closing balance. Okay, that you memorize it automatically. 5 marks will be there in your hands, minimum 5 marks. Is that the equity, what they say, the liability will be measured at the fair value. Is that fair value? IFRS 13. Okay, IFRS 13. The fair value is the present value of future cash flows, interest and capital. What is the opening balance? Is that opening balance? What I am writing again? Opening balance plus effective rate minus interest paid. Is that minus interest paid equal to closing balance? Fine. The liability, what happens? The equity element is equal to the loan proceeds less calculated liability element. Is that what is the equity? Loan minus liability. Okay, we will do this. Is that just give me time? I will make sure that you will do this. It's a loan amount minus calculated liability. Liability is measured at initial value plus market rate of interest. Is that effective rate? Is that effective rate minus interest paid? Is that minus interest paid? That's all. Is it convertible loans? We can convert the bonds. We can exchange with the future profits through bond holders normally have to accept rate of interest below the market rate. Is it rate of interest below the market rate? Effective rate and the bonds. What will happen? You see the previous case. Okay, you see the previous case. Here what's happening is that they will accept here interest is 8%, the effective rate is 12%. In convertible, what will happen? Interest rate will be more, convertible, the effective rate will be less. That's very important. Is it right? It will be reversal what we are doing. Is that interest rate will be more. Is that they will accept a rate of interest below the market rate. Fine. This is what it says. What are the compound financial instruments? Should be split into components. What is the components? The first one is liability. There will be a liability and there will be an equity instruments. Is that again all the time they are saying this. There is a option. You have the option to convert. Okay. You have the option to convert. Now, they gave you a simple illustration. Okay, they gave you the simple illustration. The convert company issues convertible loans that pays how much? 2% interest in arrears. In arrears means this is very important. Little bit you have to focus. Is that they have two things. In advance. Okay, they say in advance. They say in arrears. In arrears means they are paying on 31st December. In advance means they are paying on 1st January. Is that these points will be very, very clearly given. Okay, in arrears or in advance. Is that the market rate is 8%, being the rate of interest, equivalent debt, without conversion option. Is that without conversion option? These are the loan of 5 million is repayable in full after 3 years or converting to equity. Fine. Discount, they gave you discount factors at 8%. What is the market rate? Market rate is 8%. Fine. Now, what we have to do? We have to split it. Is that they have issued how much? They have issued what is the amount of convertible loan pay interest, the market rate, where is the amount? Their loan of 5 million is repayable. Okay, the loan of 5 million is repayable. At what rate? They say it is at the rate of 2%. Is it right? It is at the rate of 2%. How much is the cash flow will be there? Is it at the rate of what? 5 million at the pay interest at the rate of 5. How much you will get? I am putting this here. Okay, it is 5 million. Is that 5 million times 2%? Is that it is in thousands? Okay, it is in thousands. How much you will get? 100. First year interest is 100. Second year interest is 100. Third year is what? third year is the principal plus interest. Yeah, they are paying interest at the rate of, see, they are paying interest at the rate of 2%. Is that? Now, what is the rule it says? What is the rule it says? The rule says that, where is that? The rule says that the fair value is the present value. Okay? The fair value is the present value. Present value, the moment you say present value, this has to be discounted. Anytime. The moment you say it is present value, it has to be discounted. What they are saying? They are saying that it has to be discounted. At what rate discounting? Discounting is at the rate of 8%. They have mentioned here discount factor. Is that discount factor means what is as follows. At the rate of how much? 8%. The same values we will do. Is it? The same values. This is column 1. This is column 2. This is column 3. Column 4 is nothing but 2 times 3. Is it? 2 times 3. Now what happens? We are taking the interest, we are converting into present values of future cash flows, we will get the present values. The total of debt is how much? The total of debt is 4,228. Definitely, how much you have received cash? We have issued bonds to the worth of 5,000. The rule says, again we have to, again I am going back to the rule. Is that what it says? Is the equity element. See the things. Okay. The equity element is equal to the loan proceeds less liability element. Okay. Less liability element. Okay. I will put it with yellow color. It will be easy. Okay. The equity element is the loan proceeds less liability element. This is one of the rule. Okay. This is what the rule we are applying. Okay. This is the rule we are applying here. This is the rule we are applying here. What is the equity element? The value of the present value of the loan minus net proceeds minus the loan amount. The difference, first we calculate the present value, then we will take the nominal value. The difference between the present value and the nominal value is the equity. Standard procedure. Okay, standard procedure. This is where we are using when they say it is a convertible bonds. In convertible bonds, this is the procedure. Okay, now what happens? How much is the debt? Debt is how much? We have to take, we are taking the present value of debt. Okay, we will take the present value of the debt. Fair value. Okay, fair value at the initial recognition. Initial recognition at the fair value. 4,228. We are charging interest of how much? That effective rate is 8%. Is that column 1, column 2, column 3, column 4, column 5 equal to 2 plus 3 minus 4. Only difference what is there? If we are talking about the convertible, first we have to calculate the equity, present value of the bonds, present value of the bonds, difference, and whatever the difference between the initial amount and the present value of the bonds is nothing but the equity. Okay. Now the same process will happen. By the end of the third year, how much will happen? We are going to pay how much? We are going to pay back the amount which we have been received. The carrying amount of the liability at the end of 3 years will be equal to the amount repaid. Means automatically we can understand what our question is right or our solution is wrong. Okay, and most of the time it's the moment we will work it out, it will make easy. Is it clear to you all? Sumaya, Salim, Hussein and Mazin.
Yes, sir.
Fine. Now coming back to this. Okay, coming back to this, what they have mentioned like this. Okay, we will take this here, okay, so that I need some more space. A entity issued 2% convertible bonds at their nominal value. How much is the nominal value? 36,000. Interest is paid in arrears. Is that interest is paid in arrears? The bonds are convertible at any time up to the maturity of 40 ordinary shares. Is it there means $100 bond they are giving how many shares? 40 shares. The alternatively, it is the option they are having. Alternative means option. The bonds will be redeemed, means they can be repaid after 3 years. Similarly, there is a non-convertible bonds would carry an interest rate of how much? 9.5. Non-convertible, they will pay more. Convertible, they will pay less. The present value of 1 at the end of year based on 2% and 9% is as follows. What they are saying, there are two questions are there. What amount will be shown as a financial liability and as an equity? How much is the liability and how much is the equity when convertible bonds are issued? What is the point number B? What amount will be shown in the statement of profit and loss account and the statement of financial position? When they say financial position for 1 to 3 years, what we have to do? We have to show how much is the non-current liability and how much is the current liability. Same rules will never change, okay? Rules will never change. We are following the same rules all through the time. Fine. Now, when you are doing the things, is it? When you are doing the things, how much you are receiving? How much you are receiving? First, what you have to do? First, you have to take the step 1. Okay. First, you have to know how much is the debt and how much is the equity. Okay. See, this is the step 1. Is that? This is the step 1. Fine. This is the step 1. Then you have to write the journal entry. They have not written the journal entry here. Is that? They have not written the journal entry. We have to write the journal entry and subsequently we have to take the, this is the step 2. Fine, this is the step 2. Now, how much, what is the step 1? What is the step 1 here? Is that calculation of, is it calculation of debt? Is it calculation of the fair value of bonds and equity? Is that calculation of fair value of bonds and equity? First, you have to calculate this. Is that year cash flow discount factor at the rate of how much? They say very clearly, is that discount factor at the rate of how much? Because they are saying that the present what happened, the non-convertible bonds would carry a interest rate of how much? The non-convertible bonds will carry a interest rate of 9.1%. Is that the non-convertible bonds will carry an interest rate of how much? 9.1%. Discount factor we have to take, is that 9.1%, and we have to calculate the present values. Fine. The first question, little bit slowly you understand first. Okay. Now, how much is the cash flow? Is nothing but the interest amount. Okay. Cash flow is nothing but the interest amount. How much is the cash flow? How much is the cash flow? 1, 2 and 3. Okay. How much is the cash flow? 1, 2 and 3. How much amount they have? They have generated 36,000. Is it? They have generated 36,000. Fine. 36,000 at the rate of 2%. How much will get? 36,000 at the rate of 2%, very fast.
720.
Is it right? Put it in thousands. Okay, put it in thousands. Fine. 32, 36. That is also 36 thousands. Okay, 36 thousands. 36 thousands into 1 minute. 36,000 times 2%. It comes to how much? 720. Is it 720? Fine. Discount factor at the rate of how much? 9%. They mention here how much is there? 0.92, 0.84, 0.77. Okay, 0.92. What we have to do? Column 1, column 2, is it? Column 1, column 2, column 3, is it? Column 4 is nothing but 2 times 3. Is that? One class is over, do it on Excel with formulas. It will be easy for us. Okay, 720 into 0.92, how much?
662.
6?
62.
720 times 0.92,
662.
662. Forget about the decimals. Okay, don't think about, nothing will happen. See, they will see the process, very important. Every time the rate of interest will be same, 2%. Whereas at the end of the third year, how much will be there, Salim? At the time of maturity. At the time of maturity, what is the amount we have to write? 36,000 is the principal amount, 720 is the interest amount. Is it 36? If I am asking one, anybody, other people know? He replied, nothing will happen. It is all team. We are working as a team. Okay, 36,720. First year we pay interest at the rate of 2%. I have mentioned here. Is that 36 into 2%? Okay, 36,000 into 2%. Second year we will pay 2%. Third year we will pay 2%. Okay, 36 plus. Now what is the discount rate they have mentioned? 0.84, 0.77. How much we will get here? 720 times 0.84. How much? 604.8. Is it there? $720 times 0.84. How much?
604. 605.
604.8. Okay, we can take 605. Don't worry about rounding off. They will not deduct marks at all. Okay, next. 36720 times 0.77. How much?
28,000.
28,275.
Yeah.
Is it right? 28,275. Okay. Now, what happens? See the things. How much is the total of this? 662, 605 plus 28228,275. Okay, 28228,275. It comes to how much? 29542. Okay, how much is there? 29542. This is what is there? This is the fair value of bond. Okay, this is the fair value of bond. Are you clear about this? What is the equity option is there?
Fair value of bond.
Is that fair value of bond? How much is the fair value of bond? Fair value of bond is 29542. This is the fair value bond initial measurement. Is it right? Initial means at the beginning. Okay, at the beginning, initial value at the time of issue. At the time of issue. Fine. This is first thing what we have to do. We have to calculate what is the fair value. Okay. What is the fair value? Now, what is the second step 2 we have to do? We have to do step 2 on this one. Okay. On this one, we will calculate what is the closing amount, what is the opening amount, all those things. Is it right? Next, what we'll do step 2, year is a year opening balance. Opening balance you will put as, here we will not put effective rate. Is it right? What we are doing? We are putting finance cost. Is it right? Finance cost at 9.1%. Interest paid. Is right? Interest paid at the rate of how much? At the rate of 2%. You see the things. In the question they mentioned 2% convertible bonds. Is that 2% convertible bond? This 2% is nothing but interest paid. Okay? Interest paid. Now, we are going to take closing balance. Is that we are going to take closing balance. Okay, fine. Now, same concept. Okay, same concept, but definitely it is, because it is related to the bonds, we have to be very, very specific about that. 5 equal to 2 plus 3 minus 4. Now, year 1, whatever we have calculated here, is that whatever, this is the initial value. Is that initial value is how much? 29242. Is it right? 29242. This is what the condition says. 29542. Is it right? 29542 times 9.1%. How much we will get? Very fast. 29542. Yes, you said 29542. If you are doing in Excel also, no problem. I recommend you. Okay, but how you are going to work it out, that's very important. 29542. Okay, 29542 times how much? Times 9.1%. How much it will come, margin?
26,088. No, 2,688.
Yes, 2,688. Same thing what we have done. Is that we will calculate a finance cost on the opening balance. 2%. How much we have calculated? 720. Is that how much you have calculated? 720. Okay, how much we have calculated? 720. Here we have calculated this. Okay, here we have calculated this. Okay, 720. Interest paid is how much? 720. Closing balance will be how much? 29542. 29542 plus 2688 minus 720. How much you will get?
720.
31510. Check. It is there?
Doctor,
Huh.
interest paid, how it's come 720?
Got it? 30,
okay.
36,000 into 2%. Is it 36,000 into 2%? Is it there? Is it okay? $36,000 times 2%. Is it there? Are you clear about this?
Yes, Doctor.
Yeah. Second year 2. How much is there in year 2? What is the closing balance? 31,510. 31,510 into 9.1. How much? How much? $2,867.41. It is there.
2867.
2867. Okay. Rate of interest is how much? 720. Is that rate of interest is how much? 720. How much is the closing balance? How much is the closing balance?
33,657.
Is it 33,600? 31510 plus 2867 minus 720. Is it? It comes to how much? This comes to how much? 57. Okay. It comes to how much? 57. Point number 3. Year number 3. Sorry. 33567. Is that 33567 times 9.1%? How much you will get? 3062. Check.
Yes.
Okay, 3062. Is right? 33567 plus 3062 minus 720. It comes to how much?
3,054.
Doctor, finance cost will be 3,554.
3000?
54. Not 62.
Three 657 times 9.1.
9.1. Yeah.
63 na? Check.
I check it now.
Yes, 3,054.
33567 times 0.091.
54.
3,000.
Sorry. What is the closing balance? 33567. Is it right? 33657. Is that 33657? See, this is what is that, even I will do mistakes. 33657. Is that 33657? Is that 33657? 33657. 9.1. How much will they?
3,061.
3063. Is it okay?
3063, yes.
720. What is the closing balance? What is the closing balance? 33567 plus 3063 minus 720. 33657 plus
3599.
3063 minus 720. It comes to how much? 36,000.
Yeah.
Exactly. How much we have issued? We have issued value of 36,000 bond, and at the time of maturity we will pay back how much? 36,000. Okay, this is the first one. This is the step 2. Okay, now what is the equity is there? How much? How much is the equity? How much is the seat? Total value is how much? Is that step 3? Okay, you can write in step 1 also. Next time we will do that. Is that fair value is how much? See, total nominal value is how much? Total nominal value of bonds issued. Okay, bonds issued. How much? It is 36,000. Okay, it is how much? It is 36,000 minus fair value. Okay, fair value of bonds. Is that fair value of bonds? How much we have done? Where we have done in step 1. How much is there? 29542. Is that 29542? How much is the difference? 36,000 minus 29542. How much is the difference? 6458. Okay, 6458. 6458 is the equity. This is the value of debt and this is the value of equity. This is the value of debt, this is the value of equity. Fine. Now what they are asking us, they are asking us how we are going to show in the profit and loss account. Is that step 4? Okay, step 4. How we are going to show in how much? See, this is the financial liability. Is it? This is what we are talking about. The point number A. Okay, this is what we are talking. This is the financial liability. Okay, this is the financial liability and this is the equity. Is that this is the financial liability and this is the equity. This is what is a this is the answer to what? This is the answer to point number A. Is it right? This is the answer to point number A. How much is the equity? How much is the equity and how much is the financial liability in terms of debt? How we have to do? Very simple. Okay, we have to take the fair value and we have to deduct the amount of total nominal value minus amount of debt. Fine. Now what we have to show in the financials in the profit and loss account is that in the profit and loss account statement of profit and loss account. Is it right? Statement of profit or loss. Extract. Okay, only we are doing extract 1, 2 and 3. We will take what? We are going to show finance cost. Is it right? We are going to show finance cost. There is no change is said. Is it right? At the rate of 9.1%. How much? You have to show brackets. Okay, how much we are showing? 2688. Is that second year how much? 2867. Third year is how much? 3063. Is it? The same process we have done. Okay, the same process we have done. Is it right? Now, what we have to do here? Step 5. Okay, step 5. Here, statement of financial position. Is a statement of financial position. Is a statement of finance. What we have to do? We have to show equity also. Is that 1, 2, 3? Okay, 1 year 1, year 2, year 3. How much is the equity we have calculated? How much equity we have calculated?
6458.
Is it right? How much equity we have calculated? Equity is how much? Equity is
Six.
6458. Equity will remain same 6458. 6458. Once class is over, revise this. Take your time, tomorrow anytime. Okay, now the most important thing is non-current liability and current liability. Now one has to, who will tell, it is your option. How much is the non-current liability and how much is the current liability? This is convertible bonds. Okay, this is convertible bonds. The first year will be non-current liability. Is that the first year? At the end of first year, it is non-current liability. At the end of second, this is accumulated amount. Understand my point? This is the accumulated amount. Fine. This is the accumulated amount. This is also going to be what? This is going to be a non-current liability, specifically with convertible bond. The total amount which you are going to pay at the end of third year will be current liabilities. Is that this is the change what you are having? Is that because why 36,000? 36,000 we are paying in the end of last year. Last year 12 months. Is that last year 12 months? Anything which you are going to pay in the next 12 months is going to be current liability. Means how much is the non-current liability we have to show? Is it? We have to show non-current liability is 31,510 dash 33,657 dash. Here we are going to pay. Is it redeem? We are going to pay. How much you are going to pay? We are going to pay at the end of third year 36,000. This is the current liabilities. I will give 2 minutes time. Just go through it. Again I will explain. Okay, I will explain you again. See what we have done. First we want to know what is the equity and what is the debt. Okay, what is the equity and what is the debt. Here only we can do it. Is it right? This is the fair value of the bond. Is that the fair value of the bond? How much is the total value? I am adding this. I am telling you in advance that I am adding this. Is that what is the total value? Total value is 36,000. Okay, total value is 36,000. How much is the difference? Difference is going to be 6,458. Is that the difference is 6,458? This is good. This difference is going to be called as a equity. Is that this difference is going to be called as equity? Now step 2, what we are doing? We want to know how much is the non-current liability and how much is the current liability. That is the reason we are calculating step 2. Step 3, what we will do? Step is not required. Okay, step 3 is not, already we have done. Okay, next, in the next solution I will make it more shortcut. Okay, I will make it more understandable and shortcut. This is a step 4. We have taken how much we have to show it as a finance cost, and in the step 5, what is the amount of equity and what is the amount of non-current liabilities. They are mentioned here very clearly. Is there from year 1 to 3, year 1, year 2 and year 3. Is it clear to you? Yes, Sumaya, Salim, Hussein and Mazi.
Yes, sir.
Okay, fine. Okay, just one next problem we are doing. Okay, just next problem we will do. We'll have more clarity. Okay, we'll have more clarity. We'll complete and we'll stop. Okay, we'll take. Now what is there? Now you will do on your own. Okay, you will do on your own. Fine. A company issue 4% convertible bonds at the norm 4% interest. Immediately you calculate what is the interest paid. 4%, 5 million into 4%, how much? It comes to how much? 5 million into 4%, it comes to 200,000. Is that 5 million into 4%, how much? 200,000. Is that how you got it? 5 million, 5 million times 2%, 4%, sorry. 5 million times 4%, it comes to how much? 200,000. They are paying interest of how much? 200,000. Fine. Each bond, and they are paying in arrears. Now you tell me, I will do. Okay, that's very simple. Each 1,000 pounds is convertible anytime in the maturity of 400 ordinary shares. Alternatively, it can be redeemed after 3 years. What is the market rate? Market rate is 4%. Is that they gave you the 4%, they gave you the 6%. Same thing we have to do. Same thing we have to do. Is that nothing? There is no difference as such. Is that there is no difference as such. What we have to do? First case, step 1. Step 1, what we have to do? Value, fair value of bond. Is that fair value of bond and equity? Is that you fair value of bond and equity? Now, is that fair value of bond and equity? We have not written general entry. Okay, we will do that, no problem. Okay, in here we will do the general entry. Fair value. How many years are there? 3. Year. You have a cash flow. You have a discount factor at the rate of how much? Discount factor at the rate of 6%. Is it? Discount factor at the rate of 6%. Is it? Present values. Okay, present values. 1, 2, 3. Okay, 1, 2, 3. How much is the cash flow we have calculated? We have calculated cash flow of 200,000. Is it? We have calculated cash flow of how much? 200,000. Is that discount factor is how much? They have mentioned here. Anything is there, you stop me. Okay. Discount factor at the rate of 6% is how much? 0.94. Second year, how much you are paying? Second year also you are paying 200,000. Okay. Discount factor is how much? 0.89. Third year, what will happen? You will pay principal plus interest. Okay, you are paying principal plus interest. How much is the principal? Principal is 5 million. Principal is 5 million. Interest is how much? Interest is 200,000. Total it will come to how much? 5,200. Is that what is the discount rate? Discount rate at the 6% is how much? 0.84. Next class, you decide any one do on the system. You do it on the system. Okay, it will be easy for you. Any one person will do. Okay, multiply it. How much you will get? 200,000 into 0.94.
188,000.
188,000. Okay, 188,000. Keep it ready. 200,000, 200,000.89. Okay, 200,000.89. How much will they? 178. Okay, next. 520. Okay, 5,200,000 into 0.84. It comes to how much? 4,368,000. 4,638,000. How much is there? You total it. 178 plus 188.
4,734,000.
How much? 4,734,000. Check again. Okay. Now, here only we can work it out. This is the debt. Is it right? This is the debt, means financial liability. Is that debt is financial liability. Total amount is how much? Total proceeds are how much? Total proceeds are how much? Total proceeds are 5 million. Okay, total proceeds are how much? 5 million. Difference is how much? Difference is how much? Difference is how much? 266. Is it? Difference is how much? 266. This is called as Anyone? This is called as, see, this is, you see the things, what we are doing. You have the debt, you have the cash received. Is that difference is what? Difference is called as what here? What is the difference?
Equity.
Equity balancing.
Is that difference is called as equity. Always same. Always same. This is that. This is total proceed. Difference is called as what? Difference is called as equity. The 266 is the fixed. Okay, 266 is the fine. This is the fair value. Now next what we'll do? We'll see what is the non-current liability and what is the current liability. Is it that? What is the non-current liability? What is the step 2? Okay, step 2. Step 2. Okay, classification. Is it that? Classification of non-current liability and current liability. Okay, classification of non-current. Year, opening balance, finance cost. Is that finance cost at the rate of 6%. Interest paid at the rate of 4%. We have issued 4% bonds. Okay, interest paid at the rate of 4%, and we have the closing balance. Is that 1, 2 and 3? Okay, 1, 2 and 3. Whatever we have calculated, that amount will be shown here. Is that 4734000? Are you clear about this? Are you okay about this?
Yes, sir.
47340, whatever we have calculated here, is right? The same value. This is the fair value. Is that fair value at the initial at measurement? Okay, fair value at initial measurement. At the same thing, calculate at the rate of 6%, and interest paid is at the rate of 4%. How much will get? 4734 times 6%. How much will get? 2840. Okay. Now, how much you are going to pay interest? Interest will be paid 200,000. Okay, interest will be paid at 200,000. This is the amount of interest. Okay, this is the amount of interest. Is that 200,000? Closing balance will be how much? 4734 plus 284040 minus 200. 481840. Check. It is there. It is there. Is it clear?
Yes, sir.
Fine. Next. Any doubt is there, you stop me. I am once I get response from you, only then I will go forward. 481840 at the rate of 6%. How much will get? At the rate of 6%. How much will get? 289082. Okay, 289082. Fine. This is the finance cost. At the rate of how much? Interest paid is how much? 200. Is that interest rate is 200? How much will get?
4 million
07122. Okay, 4907122. Same process, 6%. Is it at 6%? How much you'll get? 294427.32. 29 2947 is it right? How much is the 200,000? Fine. How much? 4907122 plus 294427 minus 200,000. You will get some difference, okay? Rounding off. You do it on Excel, you will not get, okay? You do it on Excel, you will not get, okay? 5001549 or 5 million approximately. You can write like this, okay? You will get some difference because of we are doing it manually. If you are doing in Excel, you will not get any difference. Is it? You will not get any difference as such if you are doing in Excel. Now, Salim, tell me which is non-current liability and which is current liability.
The first one is not current liability.
Good.
Million. Okay. The second one is non-current liability. The third one is current liability.
This is with respect to conversions. Okay, this is with respect to conversion. Now, is it right? We have to say step 3. Is it right? Step 3. I am sending this file immediately after the class, not like today. Okay, just go through it tomorrow. Take your time, 15-20 minutes. Okay, take your time tomorrow, not today. Okay, now step 3, statement of
profit and loss.
Statement of, tell me margin, profit and loss. Okay, 1, 2, 3. Is it right? Finance cost. How much is the amount we have to write? Finance cost. First year how much? We have calculated in step 2.
284040.
284040. Put in brackets. Is it right? This is an extract. Okay? This is an extract. Always I repeat this. Extract. Second year how much?
Second year 289082.
Third year how much?
294427.
Is it? This is what we are saying. Now, step 4. Is it right? Step 4. Is it right? Step 4. Step 4, statement of financial position. Statement of financial position. Now, how much is the equity? Equity is fixed. Okay, equity we have calculated. Where we have calculated in step 1. Is it right? How much you have calculated equity? How much you have calculated equity?
266.
266. Okay, 266. Is it right? Now, non-current liability and current liability. Is it right? Non-current liability and current. From step 2. Okay, from step 2. How much is the non-current liability? 481840. Okay, there is no current liability. 4907122. Is it right? Here, year 3, you will not have any non-current liability. You will take it as current liability of how much? 5 million. Approximately. Okay, because we are rounding off. Okay, we are rounding off. Nothing will happen. Nobody will deduct your marks. Okay, Nobody will deduct me. Fine. Are you clear about this?
Yes.
Fine.
Yes, doctor.
Is it okay?
Yes.